Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at guerrilla technology.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps out. So today we're focusing on spotting a company right at its exact inflection point.
Right, that precise moment when the whole narrative shifts.
Exactly. We are hunting for that moment when a business transforms from, a somewhat sluggish, volatile software provider into a high-growth, heavily entrenched AI infrastructure powerhouse.
And it's a fascinating setup to talk about today because it highlights a wealth-building strategy around a company that currently boasts an 8.5 out of 10 bullish score.
Which is pretty high.
It is. The overall thesis positions this as a multi-year hold for you. But to actually capitalize on a setup like this, you have to look past the surface-level buy ratings.
You really have to dig into the mechanics.
Yeah, you have to understand the underlying mechanics of a massive corporate turnaround, and specifically why a series of gigantic new contracts are acting as a structural catalyst.
Right, something that basically forces the broader market to entirely re-rate how it values the business.
Exactly.
But, to understand where this company is going, we first have to look at the immediate past. Because this pivot from a turnaround profile to a pure growth profile is anchored entirely by their latest financial blowout.
The numbers are honestly staggering.
They really are. For the full year of 2025, their revenue hit a record $101.4 million.
Which is huge. Crossing that $100 million threshold is a massive psychological barrier for institutional investors.
It signals maturity, right?
It shows you've arrived. But the fourth quarter of 2025 is where the data shows the story really accelerating.
Oh, the earnings beat was just massive.
Right. They reported adjusted earnings per share of 34 cents.
And here is the kicker for you listening. The analyst consensus was only 23 cents.
Wow.
Yeah, they crushed Wall Street estimates by 51.11%.
That isn't just a minor accounting variation.
No, not at all. That is a fundamental mispricing by the professionals covering the stock.
And when you look at quarterly sales, they reached $35.5 million.
Again, sailing past estimates of roughly $33.8 million. So you have to ask, how did the analysts get it so wrong?
Well, the discrepancy really comes down to how the revenue is being generated now versus how analysts historically modeled the company.
Right.
In the past, they relied heavily on a project-based revenue model. And if you've ever analyzed a project-based business, you know the revenue is incredibly lumpy.
Yeah, it's feast or famine.
Exactly.
Yeah.
You might land a huge contract, have a blowout quarter, and then
Face a terrifying drop-off the next quarter.
right, while your sales team is desperately hunting for the next piece of business. And the stock market just despises that kind of volatility.
It really does. It usually assigns a heavily discounted multiple to unpredictable revenue because it's just so hard to forecast.
And the analysts were still pricing in that historical lumpiness.
It actually reminds me of the life of a freelance consultant.
Oh, that's a good comparison.
Like, imagine you're a freelancer and you're just scraping by on these unpredictable one-off gigs. 1 month, you're flush with cash.
And the next month, you're staring at the ceiling, sweating over rent.
Exactly. It's incredibly stressful, and your personal risk profile is sky high. But then, out of nowhere, you land a massive multi-year corporate retainer.
Your entire financial reality changes overnight.
It really does. You can suddenly plan for the future, invest in better equipment, scale your operations. You aren't just surviving anymore. You have visibility.
And that is the exact mechanical shift happening on their balance sheet right now.
Mm.
They are moving away from the hustle of project hunting, and they're locking into a stabilized model built on long-duration contracts.
Which is exactly what investors want to see.
Yeah. And because of that stabilization, we're seeing a drastic improvement in free cash flow. They executed a very strong profit turnaround and exited 2025 with a highly robust cash position.
And that cash position is absolutely critical for you as a potential investor to understand.
Why is that?
Well, usually when a small cap company announces huge, ambitious expansion plans, the first thing the market does is panic about dilution.
Right. They assume the company will just issue millions of new shares to pay for it all.
Exactly. Which immediately waters down the value of the shares you already own. But because they are sitting on this robust cash pile, those immediate dilutive financing risks are effectively removed.
They actually have the runway to execute these growth plans without punishing their existing shareholders.
Exactly. So if the balance sheet is fortified and the historical lumpiness is fading, the obvious question is, what exactly are they doing to generate this new, highly stable revenue stream?
And more importantly, what kind of barriers to entry are they building to protect it?
Right. Because the numbers on these new contracts are almost hard to wrap your head around for a company of this size.
They're massive. First, there's a $1.4 billion AI data center contract in Southeast Asia.
1.4 billion, just let that sink in.
That alone provides revenue visibility all the way through 2026.
And on top of that, you have a separate $500 million binding agreement with Yotta Data Services in India.
Yeah, and to fulfill that specific Yada deal, the company is deploying approximately 640 high-performance NVIDIA servers.
The HJX B200s, right?
Exactly. We are talking about the absolute bleeding-edge backbone of artificial intelligence infrastructure here.
And those chips are highly constrained right now.
Highly constrained, incredibly expensive, and immensely powerful.
Okay, so let's unpack this hardware strategy for a second, because I have to push back a little bit on the logic here.
Go for it.
Historically, software companies love being pure software companies. Software has notoriously high profit margins, sometimes upward of 90%.
Oh, absolutely.
You pay your developers to write the code once, and then you can sell 1 million licenses with almost zero additional cost. So why on earth is GRRR Technology taking on a massive CapEx-heavy hardware project? Buying, shipping, and maintaining 640 physical NVIDIA servers across the globe is incredibly expensive, and logistically, it's a nightmare.
It is.
Isn't hardware just a much harder, lower-margin game to play?
On the surface, yeah, it seems completely counterintuitive to dilute software margins with physical hardware. But it actually gets to the very heart of their competitive moat.
How so?
Where pure software is highly profitable, yes, but it's also incredibly easy for a competitor to just rip out and replace.
Right. If a client finds a cheaper software vendor, they just cancel their subscription and migrate.
Exactly. But by taking on this capital-intensive physical infrastructure rollout, they are establishing an undeniable, tangible asset moat.
Meaning, because they actually own the physical servers humming inside the data center in India, it becomes logistically terrifying for the client to try and get rid of them.
Right. They aren't just selling a basic software license anymore. They are embedding themselves as the foundational infrastructure partner for India's domestic AI build-out.
Wow.
And they aren't just handing over empty servers either. They are offering a deeply integrated stack.
What does that stack look like?
It's their security intelligence, network intelligence, and IoT technology, completely intertwined with their proprietary edge computing and facial recognition software. And it's all running natively on their physical hardware.
Okay, let's quickly clarify edge computing for anyone listening who may be unfamiliar. Because normally, instead of a security camera in India sending raw video footage all the way to a cloud server in California to be analyzed.
Which takes a lot of time and bandwidth.
Yeah, and exposes the data to interception. Edge computing means the processing happens right there, locally, on the hardware sitting at the edge of the network.
It's faster, it requires less bandwidth, and it's vastly more secure.
And when you combine that localized processing with their physical servers, you create these insurmountable switching costs.
Exactly. If a massive enterprise client or a government agency wants to switch providers down the line, they don't just click unsubscribe.
No, they'd have to physically rip out hundreds of servers.
Right. Figure out how to migrate petabytes of sensitive data without a breach and rebuild their entire hardware-software ecosystem from scratch.
That friction basically locks the clients in for years.
Which practically guarantees that long-duration revenue stream we were talking about.
Which really brings us back to that macro trend, sovereign AI. This hardware strategy makes perfect sense when you view it through a geopolitical lens.
It really does. Sovereign AI is basically the realization by nation-states that computational power and data storage are now matters of critical national security.
Right, like India, for example, does not want its critical AI infrastructure or its defense algorithms sitting in a data center governed by another country's laws.
No, they want absolute jurisdiction. They want it on their soil, physically within their borders.
And GRRR Technology is stepping in to facilitate that exact sovereign requirement by building localized, highly secure hardware-software environments.
Yeah, it is a massive secular tailwind right now.
It really is. So we have a fundamental business shift. The transition from volatile software gigs to billion-dollar hardware-anchored retainers. The business is just fundamentally healthier.
Definitely.
So the next step is looking at how the market and institutional players are reacting to this new reality. Let's look at the technicals and the market sentiment, because this is where the mechanics of spotting a breakout get really actionable for you.
Yeah, looking at the charts, the price action has recently been breaking out of a long consolidation phase.
What kind of phase?
Specifically, the stock spent months digesting its previous gains in what technical analysts refer to as a cup and handle pattern.
Okay, for those trying to visualize that without a chart in front of them, imagine the stock's price history looking literally like the profile of a teacup.
Exactly like a teacup.
The price drops from a high, it rounds out slowly at the bottom over a few months to form the bowl of the cup. And this is usually where the impatient investors just give up and sell.
They just get exhausted waiting.
Right. Then the price comes back up to its previous high, and after that, it dips just a little bit, forming the handle.
And that handle is the final shakeout of weak hands before the stock explodes upward.
It's a classic, heavily watched indicator that the market has fully digested the past and is gearing up for a major markup phase.
And what's crucial for our analysis is how the news of the $500 million Yotta deal interacted with the other technical indicators.
Right. What did that look like?
Well, before that announcement hit the wire, momentum indicators like the MACD were leaning bearish.
And the MACD essentially tracks whether a stock's recent trend is speeding up or slowing down, right?
Exactly, and it was signaling weakness. Similarly, the RSI, the Relative Strength Index, which measures the speed of price movements to see if a stock is overbought or oversold, was just sitting flat in neutral territory.
So the charts weren't exactly screaming buy.
No, not at all. But a binding agreement worth $500 million acts as what we call a fundamental override.
I love that concept. A fundamental override.
It's powerful.
It essentially means it absolutely does not matter what the squiggly lines on the chart were predicting yesterday. The actual underlying business just became exponentially more valuable today.
And the algorithms and chart readers are forced to aggressively re-rate the stock to match reality.
And that re-rating is currently exposing a massive gap between current market sentiment and Wall Street expectations.
Yeah, analyst coverage points to a price target of $19.80.
Which, if you look at where the stock has been trading, that implies roughly a 73% upside.
Which is a tremendous premium.
But here is where the mechanics get incredibly volatile and potentially very lucrative for you. The short interest on this stock is highly elevated.
It really is.
According to the data, it is sitting at 12.74% of the public float. Let's break down what that actually means.
Okay, so you have nearly 13% of all tradable shares currently sold short by investors who are aggressively betting the company would fail.
Right? They borrow shares, sell them, and hope the price drops so they can buy them back cheaper and pocket the difference.
And they were likely looking at the old, lumpy, project-based revenue model and just assuming the company would eventually run out of cash.
But the reality on the ground has changed, which introduces the very real dynamic of a short squeeze.
Right. Because when you short a stock, your potential profit is capped at 100% if the company goes bankrupt.
But your potential losses are mathematically infinite if the stock price goes up.
Exactly, because you eventually have to buy those shares back at whatever the market price is.
So when a company drops a bombshell positive catalyst like crushing earnings by over 50% and signing a $500 million contract, the stock price naturally spikes.
And those short sellers who are betting on failure suddenly wake up deeply underwater.
Yeah, and to stop their infinite bleeding, they are forced to buy shares on the open market just to close out their positions.
Which creates a violent feedback loop.
It's crazy to watch.
It is. You have new fundamental investors rushing in to buy because the company's financials look incredible, and simultaneously you have panicked short sellers forced to buy at any price just to exit their losing bets.
All of that intense, concentrated buying pressure acts like rocket fuel. It aggressively accelerates the markup phase of the stock well beyond what normal buying would achieve.
And we are already seeing the retail sentiment recognizing this setup and shifting to highly bullish.
Yeah, retail traders on platforms like StockTwits are calling the news amazing after months of patience.
The retail crowd definitely sees the fundamental override in action.
But of course, an objective analysis demands that we take off the rose-colored glasses, right? We have to weigh this bullish momentum against the potential pitfalls.
Always.
So what could go wrong over the next 3 months? What is the bear case you need to be aware of?
Well, you always have to stress test the downside. And here, the primary concern is execution risk.
Okay, explain that.
We spent a lot of time analyzing the shift to owning capital expenditure-heavy GPU infrastructure.
Hmm.
And while we know that creates a beautiful, tangible asset moat, it severely changes their risk profile in the short term.
Because it's so expensive up front.
Exactly. If that $500 million in revenue from Yada is heavily back-end loaded, meaning the company has to buy all the hardware now, but they don't get paid the bulk of the contract until years down the line, that could severely strain their cash flows during the rollout.
Pulling 640 bleeding-edge NVIDIA servers and physically installing them in India is astronomically expensive.
It's massive.
Even with that robust cash position they built up in 2025, if the cash going out drastically outpaces the cash coming in for too long, they could find themselves in a liquidity crunch.
Furthermore, you have significant geopolitical and supply chain risk.
Right.
The $1.4 billion anchor contract is rooted in Southeast Asia, which is a region with inherent geopolitical complexities.
Yeah, any macro disruptions, trade disputes, or simple supply chain bottlenecks could drastically delay their project timelines.
And because the company is still transitioning and retains some elements of its old project-based revenue model, any delays in getting those servers online can make their quarterly revenue recognition look very lumpy and disappointing again.
Which feeds directly into volatility risk. We just discussed how the high short interest acts as rocket fuel for a squeeze on the upside.
But it's a dangerous double-edged sword.
Exactly. If management misses their deployment timelines, or if those NVIDIA servers get delayed at customs, or if the Yada data center just isn't physically ready to receive them, that same high short interest guarantees violent swings to the downside.
The short sellers will smell blood in the water and double down, really punishing the stock.
This is exactly why the catalyst calendar for the next 3 months is the absolute most critical thing to watch.
Definitely. And the most immediate, undeniable event is the Q1 2026 earnings report.
Why that one specifically?
Well, the market has rewarded the announcements and the binding agreements, but investors aren't going to be satisfied with promises anymore.
They want to see the numbers.
They are going to look for initial revenue recognition from the Yada deal. They want to see actual dollars hitting the balance sheet, proving the contract is real and flowing.
And they will also be demanding concrete, verifiable updates on the $1.4 billion Southeast Asia contract.
Absolutely.
I look at the next 3 months as the ultimate lie detector test for management. It's the prove it phase.
That's exactly what it is.
The stock broke out because of the news, but Q1 2026 will reveal if they can actually execute on the nightmarish logistics of moving, installing, and networking all this heavy hardware globally.
And the market will be watching like a hawk for specific, granular milestones regarding the physical installation of those NVIDIA servers at Yada's NM1 data center in India.
Because every press release confirming a rack is powered on and running their software stack will serve as a tangible progress trigger.
Right, it de-risks the play for institutional money.
And if they do prove they can handle the logistics, there is a massive speculative upside here.
Oh, huge. The rumor mill, which management has carefully alluded to, suggests they're exploring a much broader deployment pathway with Yada.
We're talking about the potential for more than 5,000 additional servers over the next year.
Which is mind-blowing.
What?
If they successfully execute the first 640, the scale-up potential is mathematically staggering.
It really highlights why the sovereign AI secular tailwind is so powerful.
Yeah, because once a government or a massive domestic entity commits to building their own AI infrastructure, their appetite for computing power doesn't just grow linearly.
No, it grows exponentially as they realize how much data they actually need to process locally.
Exactly.
So bringing all of these threads together for you listening, how does this actually fit into a coherent strategy?
Well, Guerrilla Technology earns its high bullish score precisely because it is executing one of the hardest maneuvers in the corporate world.
Pulling off the pivot.
Yes, moving from a pure play, somewhat stagnant software model into a high-growth, wide-moat AI infrastructure player.
They are locking in a single $500 million contract that is worth roughly 5 times their entire record-breaking 2025 revenue.
And they are achieving this against a backdrop where they are crushing analyst estimates by over 50%, literally proving Wall Street's models are outdated.
With a 73% implied upside based on current price targets, The strategy outlined here isn't to day trade the daily volatility.
No, not at all.
The strategy is to view this as a multi-year hold, positioning yourself to capture the steady, long-duration revenue streams that will inevitably flow from these massive sovereign AI contracts across India and Southeast Asia.
It's all about recognizing that inflection point before the rest of the market catches up.
Just like that freelance consultant.
Right, exactly.
The moment they sign that multi-year corporate retainer, their whole life changes. The agonizing stress of the month-to-month hustle is entirely replaced by the logistics of scaling an empire.
That's exactly what we're watching happen here on the balance sheet in real time.
But, before we wrap up today's talk, there is a much broader, almost philosophical implication hidden in all of this that I think you really need to consider.
Yeah, it ties directly back to the specific proprietary technology they're deploying on those servers.
Right.
We noted earlier that this company pairs localized, high-performance data centers with edge computing and advanced facial recognition solutions.
Right. Highly secure, localized processing.
Exactly. But if this sovereign AI movement continues at its current pace, if every single nation demands complete domestic control over its AI infrastructure for national security reasons, we really have to ask ourselves a very dark, very serious question.
What's that?
Well, how long until these isolated national networks start functioning as completely separate, highly surveilled internets? Think about it. When a single government completely controls the physical hardware, the data centers, and the facial recognition software running natively on it, investing in these infrastructure plays might not just be a savvy financial decision.
It's something much bigger.
Right. It might be a bet on the fundamental restructuring of global privacy and the absolute end of a unified open internet.
That is a mind-blowing thought. It's a massive shift in how the world's information is going to be stored, siloed, and policed.
Absolutely.
It's not just about the numbers on a balance sheet or a short squeeze. It's about the literal architecture of the future. Definitely something to keep your eye on as this global narrative unfolds. Thanks for tuning in to Smart Wealth, and we'll see you next time.